Welcome back to Talk Tickers. As always, we're diving headfirst into the world of earnings calls. This time, we're breaking down MongoDB's Q4 fiscal year 2025 earnings call.
Yeah, definitely a big one. Lots to unpack here.
Absolutely. And I think for our listeners who maybe haven't had a chance to go through the full call themselves, can you kind of set the stage for us? What were the key highlights that jumped out at you?
Sure thing. So right off the bat, they had a solid quarter, exceeding revenue expectations.
That's always good to hear.
Right. And a big part of that, like we've been seeing in recent quarters, is the continued strong growth of Atlas.
Okay, Atlas, their cloud platform. Seems like that's becoming a bigger and bigger piece of the puzzle for them.
Oh, absolutely. We'll get into the numbers in a bit, but it's really becoming the core of their story.
Makes sense. Cloud is king these days, right?
Pretty much. Anyway, on top of the revenue beat, they also showcased healthy profitability and continued to add new customers at a good clip, particularly in the enterprise space.
That's always a good sign. Landing those big enterprise clients can be a real game changer for a company.
Totally. And those are the customers with deep pockets and complex needs that really benefit from what MongoDB offers. So yeah, it's definitely something to keep an eye on. They also provided some guidance for the next quarter and the full fiscal year, which we'll dig into as well.
Sounds good. So let's start with the nitty-gritty. What do their financials look like for the quarter?
All right, diving into the numbers, their total revenue reached $548.4 million. That's a 20% year-over-year increase.
Not too shabby at all.
Nope, not shabby at all. And importantly, it was actually above their initial guidance.
That's even better. Always good to see a company exceeding its own expectations. But let's talk about Atlas. You mentioned earlier it's becoming a key driver for them. How much of that revenue growth can we attribute to Atlas?
Well, let's put it this way. Atlas revenue saw a whopping 24% year-over-year jump, now contributing a full 71% of MongoDB's total revenue.
Wow, 71%. That's a pretty sizable chunk.
Yeah, it's no small potatoes. And this growth is coming from two main sources. One is new customers adopting Atlas. The other is existing customers using it more.
So basically, they're both bringing in new users and getting their current users to spend more. That's a winning combination.
Exactly. It's a classic land and expand strategy, and it seems to be working well for them. Oh, and one more interesting tidbit on Atlas. The rate at which existing customers increased their usage was pretty much on par with last year.
So steady growth on that front. No crazy spikes or dips.
Yep, exactly. It suggests a stable, predictable growth pattern, which, in the often volatile world of tech, that's something investors tend to appreciate.
For sure. Predictability can be a good thing, especially these days. But I'm curious, what about their non-Atlas business? Did that contribute anything to their overall performance?
It did, actually. Their non-Atlas revenue actually came in higher than expected. A lot of this was thanks to some big multi-year deals they landed.
Okay, so some big contracts there. But I'm guessing those deals aren't necessarily representative of the long-term trend.
Yeah, you're right. If we zoom out and look at the broader picture, their non-Atlas annual recurring revenue, or ARR, actually grew at a slower rate compared to the previous year.
Interesting. So while they're still bringing in those big one-off deals, it sounds like the overall momentum is shifting more and more towards Atlas.
Exactly. It really highlights the underlying trend. When customers are deciding where to put their new workloads, Atlas is increasingly becoming the default choice.
That's got to be good news for MongoDB.
Yeah.
Okay, so let's move on to their customer base. How has that been evolving?
Their customer base is expanding, no surprise there. They now have over 54,500 customers. And like I talked about, a lot of that growth is fueled by Atlas adoption.
So more customers overall, more Atlas customers, all good signs. Any other metrics worth highlighting on that front?
Well, their net ARR expansion rate was around 118%.
Okay, refresh my memory here. What does that number actually tell us?
Basically, it's a measure of how much revenue they're generating from existing customers compared to the previous year. So a number above 100% means they're not just keeping those customers, but they're also selling them more, which is a positive sign.
Right. So it's a measure of customer loyalty and growth potential within that existing customer base. That 118% suggests they're doing well on both fronts.
Exactly. And another thing that stood out to me was the increase in their high-value customers.
High-value customers. These are the whales, right? The big spenders.
Exactly. They now have 320 customers, bringing in over $1 million in annual recurring revenue. That's a significant jump from the previous year and shows they're really gaining traction in the enterprise segment.
Those big enterprise deals can really move the needle. So sounds like they're firing on all cylinders when it comes to customer acquisition and expansion.
It seems that way. But let's not forget about the bottom line. How profitable are they?
Yeah, revenue growth is great, but at the end of the day, it's all about the profit. So what did their profitability picture look like?
Their profitability was definitely a bright spot. They reported a non-GAAP operating income of $112.5 million.
Okay, and what does that translate to in terms of operating margin?
That comes out to a strong 21% operating margin, and their net income also showed a healthy increase.
So they're not just growing, they're also doing it in a profitable way. That's what investors want to see.
Absolutely. It suggests they have a sustainable business model. And from a financial health perspective, their balance sheet looks pretty rock solid. They've got a good chunk of cash on hand, and after recently redeeming their convertible notes, zero debt.
A debt-free company with cash in the bank? That's a pretty good position to be in.
You can say that again. That financial strength gives them a lot of flexibility to invest in growth opportunities, weather any potential storms, and just generally operate from a position of strength.
Flexibility is key in the tech world. Things change so rapidly. Okay, so we've covered their recent performance, but what about the future? What kind of outlook did MongoDB's management paint for the coming year?
Yeah, so for fiscal year 2026, their outlook is, I'd say, cautiously optimistic. They expect the stable consumption growth they've been seeing at Atlas to continue, mainly driven by new workloads coming onto the platform.
Okay, so more of the same on the Atlas front, which, based on their recent performance, is a good thing. But you said cautiously optimistic. What's the catch?
Well, they're forecasting that their non-Atlas business will actually be a bit of a drag on overall growth in the coming year.
Why is that? Are they expecting a decline in their non-Atlas revenue?
Not necessarily a decline, but definitely slower growth. And the main reason they cited is that they're not expecting to close as many of those big multi-year licensing deals that boosted their non-Atlas revenue in the past year.
Ah, so those big one-time deals were kind of artificially inflating their non-Atlas growth, and now that's normalizing a bit.
Precisely. So it's not necessarily a cause for alarm, but investors should definitely keep an eye on how the Atlas growth compensates for this potential slowdown in their non-Atlas segment.
Got it. So Atlas remains the key growth engine, and we'll need to see it continue to fire on all cylinders to offset any softness in their legacy business. What about their longer-term vision? Where do they see the biggest opportunities for growth in the years ahead?
Two areas they highlighted were AI, artificial intelligence, and application modernization.
Two very hot topics these days. AI is on everyone's mind, and application modernization.
Well, let's face it, a lot of companies are running on outdated technology.
Exactly. There's a huge potential market there. When it comes to AI, their expectation is that the revenue impact in the coming fiscal year will be fairly modest.
Makes sense. AI is still relatively early in its adoption cycle. A lot of companies are still figuring out how to actually use it effectively.
That's right. It's very much an emerging area, but they're clearly very bullish on the long-term potential of AI.
And what about application modernization? Where does that fit into their strategy?
That's actually where they see a more immediate opportunity. Specifically, they're targeting those older Java applications, a lot of which are still running on Oracle databases. Lots of legacy systems out there ripe for an upgrade.
You said it. They believe they can provide a modern, flexible alternative to these legacy systems. And while they expect some revenue contribution from this in the coming year, they really see it ramping up in fiscal year 2027 and beyond.
So AI is the long game, while application modernization is the more immediate focus. Sounds like a solid two-pronged approach. Okay, let's get down to brass tacks. What specific financial targets did they lay out for the next quarter and the full year?
All right, for the first quarter of fiscal year 2026, they're guiding for revenue between $524 million and $529 million.
And what about their profit expectations for that quarter?
They're projecting a non-GAAP operating income in the range of $54 million to $58 million.
Okay, and what about for the full fiscal year 2026?
For the full year, they're projecting revenue between $2.24 billion and $2.28 billion, with non-GAAP operating income between $210 million and $230 million.
Those are some pretty specific targets. Anything else we should note about their financial guidance?
Well, one thing that stood out was that they're expecting a slightly lower operating margin in fiscal year 2026 compared to the past year.
A lower margin. That's usually not something investors like to hear. What's driving that?
They pointed to a few factors. First, remember those big multi-year licensing deals that contributed to their strong performance this year? Well, they're not expecting those to repeat at the same level, so that's one headwind.
Right, so less of a boost from those high-margin deals. What else is contributing to the lower margin outlook?
They're also planning to significantly increase their investments in research and development. That includes their recent acquisition of Voyage AI.
Ah, yes, that was a pretty big move. Can you remind us what Voyage AI does and why MongoDB decided to acquire them?
Sure. Voyage AI is all about enhancing AI capabilities. They specialize in what's called embedding and re-ranking models, which basically helps make AI applications more accurate and more trustworthy.
So it sounds like a strategic acquisition aimed at bolstering their position in the AI space.
Exactly. They paid a hefty price for it too, $220 million, mostly in stock.
A stock deal, huh? That can sometimes dilute the value of existing shares.
Mm.
Did they address that at all?
Yeah, they actually announced a $200 million stock buyback program alongside the acquisition, specifically to offset any dilution from the Voyage AI deal.
Okay, so they're trying to proactively address any potential concerns from investors about share dilution. Makes sense. You mentioned increased R&D spending as one factor impacting their margin outlook. Anything else?
The final factor they highlighted was higher planned spending on marketing.
So more investment in R&D, more investment in marketing.
Mhm.
Sounds like they're really gearing up for growth.
That's the message they were sending, for sure. They're essentially saying, fiscal year 2026 is a year of investment. We're building the foundation for even stronger growth in the future.
A long-term vision. It makes you wonder, though, how are investors reacting to this? A dip in operating margin isn't always welcomed with open arms.
True. But I think the key here is that the investments they're making are strategic and targeted at high growth areas. They're not just throwing money around.
And what about their overall tone? Were they confident in their ability to execute on this plan?
They seemed very confident. They highlighted their strong win rates, meaning they're closing deals effectively. And they also talked about improved productivity within their sales force, particularly in the enterprise segment.
So they're seeing positive results from their current efforts.
Definitely. They believe they're on the right track and that these investments will pay off in the long run.
Okay, let's step back and put on our investor hats for a moment.
Yeah.
What are the key takeaways from this earnings call that investors should really be paying attention to?
There's a lot to digest, but I'd say the number one takeaway is that Atlas, their cloud business, is the engine driving their growth, and that growth has been stable and consistent.
So investors should be watching closely to make sure Atlas continues on this trajectory.
Absolutely. If Atlas stumbles, MongoDB stumbles.
And what about their non-Atlas business? Is that something investors should be worried about?
I wouldn't say worried, but definitely something to monitor. The slowdown in their non-Atlas ARR growth isn't ideal, but it's not entirely unexpected given the shift towards cloud and the nature of those multi-year deals.
Right. So keep an eye on it, but don't panic.
Mm.
What about their big bet on AI?
The significant investment in R&D, particularly the Voyage AI acquisition, shows they're serious about becoming a major player in the AI space. Now, whether that pays off, only time will tell. But it's certainly a bold move.
Yeah, it'll be interesting to see how that plays out. What else should investors keep in mind?
Their focus on application modernization is another interesting angle. That's a potentially huge market, and if they can execute on their strategy, it could be a significant driver of future growth.
And what about their customer base? Any key takeaways there?
The fact that they're continuing to land those high-value, million-dollar-plus ARR customers is a very positive sign. It shows they're making inroads in the enterprise market.
And finally, any thoughts on the competitive landscape? We're not the only player in the database market.
Right. They face competition from both traditional relational databases and the cloud giants' own database offerings. However, MongoDB seems confident that their technology is well suited for modern data-intensive applications, especially in the context of AI, and that gives them a competitive edge.
All right, time for our favorite segment, the This Is Not Financial Advice segment, where we let our imaginations run wild and come up with some, well, let's call them outrageous but plausible trade ideas. So what crazy idea do you have for us today?
Okay, let's get creative here. Let's call this one, I know, the No More Legacy Long Shot.
Okay, no more legacy. I like the sound of that already. What's the idea?
So remember, MongoDB is really pushing this AI-assisted application modernization, specifically targeting those Java apps still stuck on Oracle databases.
Right, they're basically saying it's time to ditch the dinosaurs.
Yeah, pretty much. And they expect this to start really impacting their revenue in fiscal year 2027. So here's the play. You go long on MongoDB, of course.
Makes sense. Got to bet on the disruptor, right?
Exactly. But here's the twist. At the same time, you short a basket of companies that are heavily reliant on those exact same old school Java applications running on Oracle. Think companies in sectors like, oh, I don't know, maybe traditional retail or old school financial institutions or manufacturing, companies that haven't really publicly announced any big modernization plans.
Interesting. So you're basically betting that as MongoDB's modernization tools gain traction, these legacy-laden companies will be left behind.
Exactly. They'll either face major disruption, have to scramble to catch up with costly modernization projects, which could indirectly benefit MongoDB, or who knows, maybe even become acquisition targets for more agile players. It's a bet on the accelerating obsolescence of clinging to the past in the age of AI and the cloud.
It's a bold strategy, Cotton. Let's see if it pays off for them. But what's outrageous trade idea number 2?
All right, for our second outrageous but plausible idea, let's call this the AI trust spread.
AI trust spread intrigue me.
So with their acquisition of Voyage AI, MongoDB is sending a clear message. Trustworthy AI matters.
Right. No one wants AI spitting out garbage data or making decisions based on bad information.
Exactly. So here's the play. You go long MongoDB, again, obviously.
Sticking with the winner.
But on the flip side, you short a pure play large language model company, an LLM company that doesn't have a really robust data layer or a strong way to ensure the accuracy and reliability of its outputs.
So betting against the AI hype machines that are all talk and no substance?
In a way, yes. The thinking here is that as companies move beyond just experimenting with AI and start using it for real mission-critical applications, they're going to need to be able to trust the data and the insights they're getting. MongoDB, with its combination of a powerful database and those sophisticated embedding and re-ranking models from Voyage AI, could be really well positioned to provide that trust layer for AI.
So essentially, they're aiming to become the bedrock of reliable AI.
Exactly. And that could come at the expense of those standalone LLM providers that maybe haven't focused as much on the data side of things.
A bet on the importance of data quality in the age of AI. I like it. But before we wrap up, we have to remind our listeners that these are just speculative ideas. We're not financial advisors.
Right. This is all for entertainment purposes only. Don't base your investment decisions solely on our crazy trade ideas.
Do your own research, people. Always do your own research. All right, to sum up our deep dive into the MongoDB earnings call, we've seen a company that's showing strong momentum in its cloud business, making some big bets on the future of AI and application modernization, and overall seems to be in a pretty solid position.
Yeah, they definitely have a lot going for them.
So for our listeners out there, what were your key takeaways from this deep dive? What surprised you? What questions do you still have? As always, we encourage you to continue your own research and form your own conclusions.
It's an interesting company in a fast-moving space.
Absolutely. Thanks for joining us on Talk Techers. Stay informed, stay ahead.